Hi everyone, today we are going to be discussing on AAT Sri Lanka level 2 AFC, that is Advanced Financial Accounting subject, and we will be discussing chapter 1, which is elements and components of financial statement and adjustments for financial statement. So the first part would be the elements. So you must have studied in your first levels elements of financial statements are assets, liability, equity, income and expenses. So these are the main 5 elements of the financial statements. Now when it comes to this level or the advanced level, these will be represented in 2 of the main statements, because 2 of the main financial statement which we will be studying further down in the syllabus. And now assets and liability and equity, all 3 will be represented something called the statement financial position, and income and expenses will be represented in the company's income statement. So, and in the statement of financial position, it will show all these balances of the assets, liability and equity as at date. Whereas income and expenses in the income statement will be shown for a period. For example, first April 22, 31st March. So this will be the period, and when it comes to the income, the statement of financial position as of date will be 31st March 2021. So the asset balance, the liability balance and the equity balance shown in the statement of financial position will be shown as of 31st March, whereas income and expenses is for the year starting from 1st April 2020 to 31st March 2021. Now we will look at few of the components of each of these elements. So we will see what inclusive and what is exclusive assets, what's inclusive of liability, what is equity and what is expenses, and what is income in detailed manner. Now when it comes to assets, it's an economic resource controlled by the entity as a result of past events which has the potential to produce future economic benefits. So these 4 components or the 4 points you have to keep in mind when it comes to defining asset. It should be an economic resource controlled by the entity as a result of past events which has the potential ability to generate future economic benefits. So these 4 points should be included or should be considered when defining what's an asset. So it should be an economic resource, which should be controlled by the entity or it should be within the control of the entity as a result of past events, and it should have the ability or the potential to generate future economic benefits. So apart from this future benefits or this future benefits from assets. Future benefits from assets can be either direct or indirect. This is something cash from sales. This can be cost reduction. Now, if you, for example, right, assume direct. Now, assume you have a debtor, or assume there's a customer. You have a potential customer. You are a cloth manufacturing company. You are a cloth manufacturing company, and in this cloth manufacturing company, you have a customer called Sam. He issues a sale, or he want to purchase from us. T-shirts worth of LKR 1 million. So this is a cash sales, right? This is a cash sales of LKR 1 million. So this is directly cash comes into the company. Directly cash comes into the company. So this is the first type, cash from sales. So it direct. Anything that is cash or cash equivalent, cash or cash equivalent coming into the company. Directly. So when it comes to indirect for future benefits, when it comes to it means cost reduction. So cost reduction in the sense, let's assume same cloth manufacturing company. Same cloth manufacturing company, but in here initially you are using electricity from CEB, Ceylon Electricity Board, right? So this will cost about 100,000 per month, LKR per month, right? And now the management says, let's bring in solar panel. solar panels. So solar panel will generate half of the electricity requirement, 50% of electricity requirement, right? It generates 50% of the requirement. So you can bring down this cost. So electricity cost to CEB now would be 50,000, since you are bringing it down 50% per month. So this 50,000 here would be cost savings. This 50,000 would be the cost saving. So this would be indirect. So it's some form of cost reductions or cost savings. Right? So if it's direct, it should be cash or cash equivalent. Whether it's indirect, it should be a cost reduction or cost savings. So the example here, I will explain it again. So in a cloth manufacturing company, the current electricity bill from CEB is about 100,000. So the management says that to bring in solar panels to generate 50% of the electricity requirement, assuming the cost is equivalent to 50%. So when you bring in the solar panels from some other suppliers, and if you fit it, the electricity of payments to CEB would be 50,000 LKR per month. So initially you were paying 100,000. Now since the use of solar panels, you are only paying 50,000. So there is a 50,000 savings or cost savings or reduction. So apart from this, another concept of economic benefits. So at this level, economic benefits can be using an asset to manufacture goods or provide services. This is one. Apart from that, in exchange for another asset, so using one asset to buy another asset. Okay. For example, if we are here, if you say, if you have old grinding machine, so you can sell this sell it, and with the proceeds you can buy a new machine. So using one asset to buy another asset. Here, for example, you can say grinding machine. So whatever to grind flour or some sort of spices or whatever. So you buy one grinding machine old, and you can sell it, the one which you have, and you can use the proceeds to buy a new machine. So the old machine, if you sell it, it will be what? Say if you sell it for 40,000, and the new machine is about 80,000. No, say 70. So you have to additionally put another 30 to this, and you can settle off this 70,000. So you can using one asset to buy another asset similarly. And the third would be using to settle a debt. So example, let's say you have a creditor to settle and debt. Debt publication. Let's assume that you have a customer, creditor worth 1 million. So assume now in cash you have 600,000. So in cash you have 600, but this guy is 1 million, LKR. So another 400,000, there's a misbalance to settle this debt. So you can give a car or a computer, assume a computer worth of 400,000 in exchange to settle this debt. So you can use cash. Cash is also an asset, as well as a computer is also an asset. So in the event of 1 million LKR, in order to settle this creditor or the debt publication you have, assume that your company has a cash balance of 600,000. There is a 400,000 balance. There's a mismatch in sense you have 400,000 less. So in order to settle this 400,000, you are telling the credit customer, look, we have a computer that's worth of 400,000 rupees or LKR. I'll sell it to you and please settle the debt. Okay. So this is another scenario where the economic benefits. So the first one is using an asset to manufacture goods and services which you can sell later with a profit. Using one asset to buy another asset. So basically, let's say you have an old machine or old grinding machine or a old car or a old lorry or container, whatever, you can sell it and you can get the proceeds and you can buy a new asset. And the third one is to settle a debt obligation or an obligation, credit. Let's say you have a creditor which a supplier, say some supplier, he has about 100,000 worth of, he had to settle. 1 million. In this 1 million, in order to settle this, you are asking the customer, the creditor, look, I have a cash balance of 600,000. I will pay you with cash 600,000, but the balance 400,000, I do not have cash. So I have an asset, I have a computer that's worth of 400,000 LKR. I'll give you this, and please settle off my debt, right? And the fourth one is distributing to owners. No, this is simply, it's like now if it's a private limited, then you can either go as director fees. And if it's a PLC or a public listed company, then in this or public limited company, in this case it will go to the shareholders as dividends. So these are the two main things when it comes to distributing. So if it's a private company, it basically goes to the director fee or director bonuses, director payments to directors, some sort of a line item. But when it comes to PLC, it's basically you are giving us dividends, so bonus, or you can split the dividends into first dividend, second dividend, and likewise. So basically it's dividend you are paying. So when it comes to economic, you can use an asset to manufacture goods or services which you can sell later, using one asset to buy another asset. To settle a debt obligation, saying let's say a creditor, you are settling partly by cash and partly by an asset, a physical asset. And the final one is distributing to owners, where when it comes to private companies, you are directing as director fees, and when it comes to PLC, it's basically you are sending it as shareholders dividend. Now the next would be the physical. Now for example, now assets, there are asset classifications. So how can you group them? So first, with the physical existence, physical means there's a physical existence, meaning that it has a structure, you can touch it, you can feel it, it's an object, it's visible, right? So in that manner you can say one tangible, the other one you can say intangible. Right? So tangible would be buildings, so something you can see, touch, feel. So there's a physical structure to it, there's a structure. So basically you can see it, you can touch it, you can feel it, and it takes up space likewise. So when it comes to intangible, it is trademarks, patents, or goodwill. Now don't worry about these terms, you will later learn how these are incorporated into the financial statement, but these are intangible. It cannot be seen, touch, or feel. So but do keep in mind, when it comes to patent or trademarks, there is a certificate. So that certificate is the authorization copy saying that okay, you have a patent. For example, now let's say now if you have seen McDonald's or for example, if you are a comic fan or if you are into this Marvel universe and DC comics, now they say DC TM, Marvel TM. So that means these DC and Marvel, those are trademarks. You cannot use this name. They can sell goods and services under this name, but another party cannot sell. Even McDonald's is TM. Those are trademarks. You cannot sell under those trademarks. So for example, patent, let's say for example now hair carb, they deal with activated carbon. Now if you the owner or the chairman of these groups, the Haley's company, the owner, if you the America Pereira, in one example he said that he had found out a new activated carbon, right? Activated carbon, and which he did not patent. Now assume that you found a new formula. Now let's say you are working in hay carb and you found a new formula. To produce super activated carbon. You can patent it. That means no one else cannot manufacture this product except you, but you cannot give license, or you can say permission to the other party. cannot manufactured by others. So this is when it comes to classification, physical existence, tangible and intangible, likewise. But in the accounts or in the account statements or in the financial statements, you do not classify as intangible and tangible. You classify them based on the liquidity. Liquidity in the sense liquidity is how quick can you convert it to cash, right? And when you are writing liquidity in the statements, in the financial statements, liquidity is higher when it goes down. Look, for example, now liquidity we separate it in two ways. One is non-current, right, and the other one is current. Now, simple definition is this should be more than 1 year and this should be less than 1 year, right? This is non-current assets greater than 1 year, this is non-current. So when you are listing items here, for example PPE, property plant equipment, right? When you are listing here, you start with inventory, trade receivables, bank and cash. So liquidity is higher when it goes down. So cash should come last. The inventory is harder to convert to cash easily. Trade receivables later on. Cash at bank and cash the liquid cash you have at store. So here PPE and goodwill also comes down here, right? So how quick you can convert it to cash? Liquidity is simple in simple terms or simple layman terms. It means you can how quickly you can convert it to cash. So the cash is the ultimate liquid form, right? Beyond that there is no liquidity. So if you have it in cash, that's the ultimate. So in the current assets, the final statement should be cash, because that is the final structure you can get, or the final output or the final conversion of all these assets will come up on the end of the day to cash. You can convert it to cash. So again, if liquidity is simply how quick you can convert it to cash. Let's say an asset, how quick can you convert it to cash? The liquidity is higher as the items in the below in the sense, now let's say in the current assets, inventory, trade receivables, bank, cash, these are the items. But inventory would be the least convertible to cash, so that's the first item, and the cash being the last. So this is with regard to assets in the element statements. Okay. Now the mixed component is liability. Liability. So when it comes to liability, it should be a present obligation. It should be a present obligation as a result of past event. statements which can lead to a future outflow of economic benefits. So please do remember, so when it comes to a liability, it should be a present obligation as a result of past events which will lead to future outflow of economic benefits, right? So when it comes to a liability, so these three components should be there, right? Okay. So liability can be legal. How can a liability arise? So it can either come from a legal perspective or a constructive obligation. Or legal obligation. So if I assume now this, the first criteria, the present obligation should come from either legal obligation or a constructive obligation. Now legal obligation in the sense, let's say a contract, you are bound by a contract, a sales contract, it can be a sales contract, purchase contract, or some other warranty contract. So these contracts will have legal terms. Which are binding. Legal terms which are binding. So legal obligation and constructive obligation. So present obligation, the first criteria in order to satisfy a liability, it should be a legal obligation. So legal obligation either can come from a contract in the sense sales contract, purchase contract or warranty contract, whatever, where the legal terms which are binding. So you basically sign it, that means you are bound. You sign something like this, if you sign it, you are bound by it. So it will create apart from that, any other legal proceedings, one post case, will come into this category.